even when their profits look similar on paper? Welcome to our deep dive into valuation by McKinsey & Company. I'm here as your host, and I'll be guiding you through the ideas that power modern finance.
Glad to be part of this series. I'm excited because valuation isn't just a finance buzzword, it's how we decode what drives business success. Whether you're curious about investing or leading a company, we promise practical frameworks and examples you can use.
Here's what's ahead. We'll unpack why valuation matters, dig into the principles behind value creation, tackle risk, and explore must-know tools like discounted cash flow. Plus, we'll look at real-world case studies and strategy applications.
And we'll make it relatable so you're not just memorizing formulas. Let's kick off with the big question. Why do we value value in the first place?
What's fascinating is how valuation acts as a common language between investors and managers. It tells us whether a business is actually making its shareholders wealthier, not just earning profits.
True, and that distinction is crucial. Long-term value creation is what investors reward, so companies that focus only on quarterly earnings can miss the mark. This book makes it clear. Sustainable value trumps short-term wins.
I've seen managers get sidetracked by metrics that don't reflect true economic health. Valuation cuts through those distractions.
That actually reminds me markets themselves are pretty good at filtering out mere accounting tricks. Over time, stock prices tend to reflect real value, not just flashy numbers.
Let's dig deeper. The authors argue that cash flow, not accounting profit, is the real driver of value. It's a game changer for how we look at financial statements.
Absolutely, because accounting profits can hide a lot. What matters is economic profit when cash generated exceeds the cost of capital. It's like the difference between earning money on paper and having actual dollars in the bank.
So, if a company reports huge profits but burns through cash, it's not really creating value. Cash flow tells us what's really sustainable.
And investors use this principle to judge whether a business is worth backing long-term. It all comes down to the quality and timing of cash flows.
Funny you say that about timing, because risk plays a huge role. The book stresses that value is conserved. You can't just increase it by shuffling risk from one place to another.
Exactly. And that means managers need to understand how risk affects their valuation models. Ignoring risks can lead to overconfident decisions and costly surprises down the line.
I've seen teams underestimate risk, thinking they can just offset it elsewhere, but ultimately, the market prices it in.
Which is why a disciplined approach to risk integrated into valuation is essential for more accurate business decisions.
That brings us to stock market performance. Prices aren't just snapshots, they reflect investor expectations about future value, but things aren't always as rational as they seem.
Right, and that's because behavioral biases and short-term pressures can distort valuations. Sometimes investors overreact or undervalue companies based on headlines rather than fundamentals.
So, even with efficient markets, it pays to understand the psychology behind price swings. It's not just about crunching numbers.
And recognizing those distortions can help you spot opportunities or avoid costly mistakes when making decisions about buying or selling stock.
Now for the heart of the matter, discounted cash flow, or DCF. It's considered the gold standard for valuation, but it's only as strong as your forecasts.
That's where things get tricky. DCF requires projecting revenues, costs, and capital expenditures, sometimes years into the future. If you get those forecasts wrong, it can unravel your entire analysis.
I've seen DCF models that look precise, but a small change in assumptions can swing the outcome massively. It's a reminder to stay humble about forecasting.
And to always question the inputs, are they realistic or just optimistic? DCF rewards disciplined thinking and careful scenario planning.
Speaking of discipline, calculating the weighted average cost of capital WACC is fundamental. It combines the cost of debt and equity, essentially reflecting how expensive it is to fund a business.
And WACC isn't just a formula. It depends on beta, risk premiums, and the company's capital structure. These factors show how risky investors perceive a firm to be, which directly affects valuation.
Tweaking capital structure can change a company's risk profile, and therefore its cost of capital. It's a balancing act.
Which means managers need to be strategic about financing choices. They're not just financial details, but value drivers.
That leads us into advanced topics. Valuing high-growth firms, cyclical businesses, and companies in emerging markets requires special methods. One-size-fits-all doesn't work.
Absolutely. Because factors like inflation, governance, and currency risk add complexity. Sometimes you need to adjust models for local conditions or volatile markets.
And the ways these businesses scale or weather downturns can be very different from mature companies. Tailoring your approach matters.
I've found that adapting valuation for unique circumstances is both challenging and rewarding. You end up with much more accurate insights.
After tackling those complexities, valuation also guides big decisions like mergers and acquisitions. It helps managers judge if a deal grows or destroys value.
And it's central for capital allocation, knowing where to invest, when to restructure, or how to maximize returns for shareholders.
I've seen how disciplined valuation can transform strategy, helping leaders stay objective during high-stakes negotiations.
That's what makes it so powerful. Valuation translates abstract strategy into concrete financial outcomes.
To ground all these principles, the book includes case studies that show valuation in action. Real-world examples make the theory tangible.
And those stories underline how disciplined valuation leads to smarter, more sustainable decisions. Seeing the process play out helps bridge the gap between classroom and boardroom.
It's always eye-opening to see how mistakes or discipline in valuation shape a company's fate.
And it's a reminder, experience and rigor go hand in hand if you want to avoid pitfalls and seize opportunities.
Looking back, 3 key lessons stand out. First, valuation is about disciplined analysis, not gut feeling. Second, cash flow is the true measure of value, not just profits. Third, understanding risk and market dynamics is essential to make informed decisions.
And here's your actionable step. Start evaluating companies by focusing on their cash flow and risk profile, not just headline numbers. That's how you'll get closer to spotting true long-term value.
Thanks for joining us on this journey through valuation. We hope you've gained insights you can actually apply in your work.
Keep thinking long-term. And remember, the smartest decisions are grounded in disciplined valuation. Until next time, stay curious and keep building value.